In Blunteville, Tennessee. Are you wanting me to stand still? We had so many people after last year, and they were like, "Can you send me? I missed some stuff. Can you send it to me?" So Steven's trying to record me, and I've never done that before, and it's very uncomfortable having a camera in front of me. I got to stand still, and I've got a camera in front of me. So I live in Blunteville. We have offices in Grundy, Virginia, Pounding Mill, Virginia, and Bristol, Tennessee. Stephen has just opened an office in Lexington, Virginia. I don't have any presence there, but he can do real estate transactions in Central Virginia if anybody needs that. We have a 15-year-old son and a 12-year-old daughter. Personally, we have done flips. We have residential and commercial property, and a substantial portion of my practice is for real estate investors. Is that mine singing or somebody else? We also have title companies, and we write through Old Republic. So what's new with the Big Beautiful Bill? How many of you all were here last year, just to give me an idea? Okay, there's going to be a couple of things that I go over because it's so important that we need to understand it. So there are some things that are really good with the Big Beautiful Bill, and there are some things that are not so good with the Big Beautiful Bill. Some things are not so beautiful. Part of the good is that QBID is here to stay. QBID is Qualified Business Income Deduction. It was started by the initial Tax Cuts and Jobs Act of 2018, and it allows up to 20% of small business income to be non-taxable. It is huge. It is an amazing deduction. They've played with other deductions through the years. We had the domestic activities production deduction, if you all remember that. QBID is so much more inclusive, and even in your real estate businesses, you can be you can be exempt from paying tax on up to 20%. There are some thresholds that you have to meet with that. One is based on the amount of property that you own, and two is based on W-2 wages. So on a Schedule C, you use the W-2 wages. On rental property, they created that other threshold because of QBID for real estate investors. So the tax code is written that everything is taxable, and then they incentivize things that they want you to do. And real estate investing is one of those things that they want us to do. And so because they want us to do it, they incentivize it. I guess it means that a bunch of lobbyists are up there and working for us, so I guess that works. But up to 20% of your profit from your business should not be taxable. It's huge. Bonus depreciation. I'm going to come back to this, and this is one of the things that I initially didn't have in my slides, and I've added it back because we have to understand what being a real estate professional means. So I'm going to talk about that one at the end. Bonus depreciation is huge. It went down to 40%, and now it's back up to 100%. So any asset, not the outside four walls and not the interior of a property that you buy, if you don't do a cost segregation study, but any other asset that you buy is going to be 100% deductible with bonus depreciation. Bonus depreciation, we can also go into a loss. Section 179, a lot of people think, well, Section 179 always gave us 100%. There are top thresholds, and they don't allow you to go into a loss. And as a real estate professional, there's nothing more beautiful than a loss, right? Okay. Estate tax exemption is now going to be $15 million. So you can die with $15 million and not have any estate tax. Now, most of us look at that and say, we ain't going to be worth that anyway. But we don't know what those rules are going to do. So for right now, if there's a death in 2026, it is $15 million exemption. Portability is huge as well. So all of these are good things. Portability started in 2018. If you saw estate plans from prior to 2018, all of the assets were split between the spouses. The reason they split between the spouses is so that each person's estate tax fell under the threshold. Because what happens when one of you pass and use up the exemption by not claiming it because everything goes to your spouse? Then the spouse passes. We all of a sudden have a taxable estate when we wouldn't have if we split our estates. Since 2018, we have portability, which means we'll kill you off, Stephen. If Stephen dies, I get his portability. I get $15 million. So even if estate tax goes to zero, I still have his $15 million. Okay? If it stays at 15 million, I can have 30 million when he dies and not have an estate tax. Does that make sense? So if anybody has had a spouse die, right now statute of limitations is 5 years because of COVID. If anybody's had a spouse die, you need to see me afterwards. Most of us don't think it's going to be an issue. We don't think it's going to be an issue. We just don't know what rules we're going to be playing with in the future. So while we can capture that, it's a good option if anybody has had any family members pass, spouse pass. PTET. Pass-through entity tax was created to avoid the SALT limitation. SALT limitation is state and local tax. So even if you paid $50,000 in state and local tax, you could only claim $10,000 even if you itemized. So what they're trying to do is keep everybody from itemizing. They've raised that threshold so high, and then they're making limits on everything with it. So with PTET, it is called pass-through entity tax. States with income tax, Virginia, how many Virginia residents do we have, or with Virginia property? I know there were some that said Virginia property. So you can, if you have a pass-through entity, you can pay the tax at the entity level, get a credit on your personal return, and get a tax deduction for it without having to itemize and without having that limitation. SALT has raised now to 40,000. So we probably won't have as much of an issue in these lower income tax states. Some California, New York, those you're still going to have an issue with, but we won't have as much of an issue with that. Opportunity zones. Has anybody done anything with opportunity zones? Opportunity zones are actually going to be a really nice option going forward. So prior to Big Beautiful Bill, the issue with the opportunity zone was you got to step up in basis after 5 years, but the 5 years that you held the property had to be prior to December 31st, 2026. What they have done is said that you're going to get a step up in basis periodically, and there is no end threshold. There's a lot of opportunity zone properties, and if we could get that step up in basis, it could make that sale even more beneficial. So opportunity zone is going to be something that we need to be looking for as real estate investors because of that step up in basis if we're going to hold the property for long periods of time. So if you want to explore that one more with me, holler at me and we'll explore it more. There's a lot of opportunity there that there wasn't prior to Big Beautiful Bill. Additional standard deduction for seniors. A lot of people were real excited about tax-free Social Security. Social Security isn't tax-free. They have allowed an additional standard deduction of $6,000 per person over 65 that will offset some of the taxable Social Security. They get it whether they have taxable Social Security or not. So it is just an additional standard deduction. Child tax credit goes to $2,200 a kid. Forgiveness on student loans. Anybody do the student loan forgiveness thing? That's a teacher thing typically. But did you? Are you? So prior to 2024, if they wrote off that student loan, that became taxable income to you. 2024 and 2025, they did a Band-Aid fix and said it's not going to be taxable. They've made it permanent now. So when they forgive those student loans, it will not be taxable income. There were ways around having it taxable anyway. If you were insolvent and bankrupt, if you could prove that with the debt, your assets were less than your liabilities, which a lot of times people can do, they could avoid it. But now it doesn't matter. It is automatically not taxable. It was a real big issue for teachers because then they get hit with all this income. They're still better paying the tax, but it's hard to pay the tax in 1 year when that forgiveness hits. 529s. I was not a fan of 529s. I am now. You're shaking your head no. They are much better than they were. So 529s, I had an investment guy, and I think he occasionally comes here. He's not here today, so I can tell this story. He had come to Grundy. My daughter was about 2, and we had a 529 that we started when our son was young, because it was kind of the right thing to do. And then the more I read about him, the more I disliked him, and so it's just this blah. And so when he came and he's trying to sell me something, and I met with him, and apparently I was in a mood that day because he said, "Why do you have a 529 for your son, but you don't have one for your daughter?" And she was about 2, and she was a difficult 2-year-old. And I said, well, I haven't really decided I'm going to keep her yet. And but 529s have got more advantageous over the years. Growth on them is tax-free. The ability to roll over to a Roth up to $35,000. So there are some limits on that. The account has to be established for 15 years. You cannot self-direct 529s though. I tried to do that this year. Cannot self-direct 529s. So it's a better option. K through 12 education now can be paid for through them. That was a political lobbyist thing. They wanted them expanded. They wanted a tax deduction for the money going into them. And the resolve was, we'll let you do K through 12 education with them. Use your own money to pay for the education anyway. I mean, yeah. But, so I'm not still 100% of a fan, but I'm a little bit more than I was. So the charitable deductions, and this is going to be, there's a pro and a con to this one. Charitable deductions, you're going to be able to claim $1,000 cash contribution per spouse. So married filing joint's $2,000, single is $1,000, that you can claim if you have documented cash contribution. It's above the line, so it's not, you don't have to itemize to claim it. That's the good. I'm going to jump ahead because it goes right with this. The bad is that if you do give to charitable, there's going to be a floor. So like with medical, you can't claim the first 7.5% of stuff that you pay in medical. There's going to be a floor with the charitable as well. And so if you know that you're going to give to charity, a donor advised fund may be a good option to establish in 2025 so that you bypass that floor altogether. Has anybody ever done a donor advised fund? Okay, really nice option. So donor advised fund, basically you give into a fund for charity. The only criteria is it has to go back out for charity. It's still within your control. You can do a grant to any 501c3 anytime. So I have an automatic grant that goes to Young Life. We have an automatic grant that goes to the church. Once a year we have an automatic grant. Our daughter wanted to sponsor a child, so she gives us the cash and we do the grant out of the donor advised fund. It grows, so all of the growth in it is tax-free. One thing that is a nice option is if you know you're going to give to charity, do every other year. So itemize 1 year, then the next year take standard deduction. Pay your when are Sullivan County property taxes due? February 28th. Do you want to know why February 28th? So you can itemize every other year. City of Bristol, I think, is January 5th. You can itemize every other year. So if you time those deductions, then you can hit the other year. So make your January house payment in December. Get that interest paid up. Does that make sense?
Kind of. Can you explain
Yeah.
that just like with maybe real numbers real quick? You're just saying try to pay your taxes in February and December.
Correct.
Because you'll take the automatic deduction
Correct.
the other year, right?
Correct. Correct. So let's say your mortgage interest is $10,000 and you know that you're going to give $15,000 to the church and your taxes are $5,000. So you're at $30,000. You're not going to be able to itemize. But if you save those charitable contributions and those property taxes and you push 2 years worth into 1 year, you're going to get $33,000 for your standard deduction, and then the next year you're going to get $60,000 when you itemize.
Okay, I got you.
So your savings on that $30,000 is going to be, $10,000 if you're in a 25% bracket. Does that make sense? Just for making that timing work. Any questions on that? It's a really nice option with a donor advised fund. You don't want to give 2 years worth of contributions to the church in 1 year because then they expect those same 2 years for the next year when they're budgeting. Okay? New car interest. Anybody wanting to buy a new car? No? Okay. So new car interest on a personal vehicle is deductible up to $10,000. There is, that has to be produced in the U.S., so there's a tool that we can check the VIN before you buy and make sure that it qualifies. 1099s. How many hate 1099s? I hate them. Absolutely despise them. Nobody's happy when they get a 1099. Everybody's happy when they get a W-2. There's nothing more beautiful than a W-2, and there's nothing more ugly than a 1099. Okay? Limit has been $600 for how many years? As long as I have been licensed, it has been $600. That limit goes to $2,000 in 2026. So as long as you pay somebody contract labor less than $2,000, no reporting. It needed to go up. $600 was ridiculous. HSA. How many like HSAs? Love an HSA. Very, very nice option. An HSA is known as the triple benefit. You get a tax deduction when the money goes in. Growth on it is tax-free. And as long as you take it out for unreimbursed medical, it's tax-free again. It's a very, very nice option. If you don't have a high deductible plan, and you can, unless you have major health issues, look into an HSA. Very, very nice option. They are expanding the uses of an HSA. So you can now pay Medicare premiums out of your HSA account. Used to, you couldn't pay premiums out of it. That is a new thing. But HSAs are very, very beneficial. You also have until April 15th to contribute. So I have a lot of clients that say, just let me know how much I need to contribute. And I'll give them different options of, if you contribute this much, this is what you'll owe or get back, all the way up to the maximum. HSAs are a really, really nice option. Another nice option with HSAs is you can accumulate what you pay out of after-tax dollars, and it's like another emergency fund. It is not something that has to be taken out in the year of the expense. So if you keep up with how much you have in expense, and then, oh crap, I need a heat pump and I don't have the money for it, well, I've got the documentation of that, and you can take it out as an unreimbursed medical, as long as you keep up with it. You have to keep up with the expenses that you have paid, but you can accumulate those.
So you can leave it in the HSA for
Yes.
2025 and pull out the 2025 expenses in 2026?
Whenever you need to.
Even like 10 years from now?
Doesn't matter, as long
Wow.
as you have the detail of it.
Oh.
I'll tell you a story on the HSA. Our HSA is like the golden fund that I never want to touch. And January 3rd, Stephen tears his bicep tendon. So we go to the ER. That was a terrible experience. They end up wanting to do surgery. Well, they're going to do surgery on a Friday. And our daughter was scheduled to have braces put on Thursday. So in 2 days, I had to come up with $10,000 to pay for her braces and his bicep tendon surgery. I collected up the amount that I had in reimbursement for my HSA. I will claim it as unreimbursed medical. I took it out and paid for her braces and his bicep tendon surgery. Does that make sense? It's a really, really nice option, builds a lot of flexibility. HSA is a great, I call it the golden fund, but it is a great option. Yes, ma'am.
Can't you take it out for any reason after a certain age, like age 65?
So not without paying tax on it. It has to be unreimbursed medical even at 65. Unless that's changed, but I'm 90% sure I'm right on that. Any other questions? 529s I've added this time monitoring thing, and it's obnoxious. It keeps popping up. Like, why are you not touching anything? 529s used to only be transferable to up to first cousins. Now they can transfer down a generation. So that is another nice option with that. 529s can also pay student loans up to $10,000. So my guy who doesn't like 529s, I don't disagree with you, but let's play through this scenario. Let's say you've got a kid. What's your name again? You don't want me to call you out. I won't call you out. Your son is who I was going to call out, but I won't. We'll call him John. All right, John. So he can get a subsidized student loan. Take out the student loan, leave your money in the 529, no interest on the student loan because the government's paying it. 6 months after you graduate, take the $10,000 out of the 529 and pay it off, and you just made that much in growth that you didn't pay anything in interest. Does that make sense? Any teachers? Okay. PMI is not deductible on Schedule A. There used to be a mortgage insurance premium. That's something they've pulled back out. 10T, Rule 10Ts. So let's say you want to retire at 50, but you need some money out of retirement. Oh no, sorry, that's something else. 10T, that's tracing. So you borrow against a HELOC to buy a rental property, but you want to deduct your interest on the rental property. How many of us have done that? I went somewhere. Most of us have done that. As long as you do a 10T election, then you can take the interest on the business. You don't have to take it on Schedule A. There is an election for that, but the election doesn't have to be filed with the return. So it needs to be with your return, but there isn't anything that goes to the IRS with that. Any questions on that? I get a lot of questions about that during tax time. Can I use my HELOC to buy a property and still claim the interest? The answer is yes. What if you redo your kitchen and buy a property with it? You have to be able to trace it out. You have to trace that your personal payments made your payment on your kitchen and your business payments made your payment on your property. Okay? Y'all are not nearly as talkative as last year. Loan against 401k. How many of you have been hit with one of these 1099-Rs with no withholding? You just haven't had an exciting life, apparently. Okay. So the worst thing as a preparer to do is you're going through their information and you end up with a 1099-R from a retirement account and there's no withholding on it. Now, when I see that now, I know exactly what happened. You had a loan against the 401k and you were terminated or you quit. When that happens, that loan is automatically taxable income. In the past, you had 60 days to put the money back to avoid paying tax and penalty on that. And that was a terrible conversation because for those 60 days, you don't have a job. You can't pay it back. You can't get a loan. It is awful. And it may be $10,000 and it may be $100,000. It is miserable because nobody has the money to pay it and they don't have the money to put it back during those 60 days. What the big beautiful bill has done is extended that time frame so you have until the due date of the tax return to put the money back. So then by that point, hopefully you have another job and I have something I can tell you that you can do other than cry, because that's really what has happened in the past. It's awful.
How many people do you make cry?
I'm sorry?
How many people do you make cry?
Do I make cry? Occasionally. All right, the bad. During COVID, a lot of questions about unreimbursed job expenses for employees. No, you can't claim them. They did not allow anything. So even during COVID when they had to work from home, even during COVID when you ended up paying a lot of expenses on your own because you couldn't go to the office to get things, we really thought that they would fix this and extend it so that you could claim unreimbursed job expenses. The reason they didn't is the theory is if you're employed, your employer is supposed to take care of everything for you. How many of them do? Yeah. We talked about the new floor on charitable contributions. Tax-free overtime. Anybody W-2 job have overtime? Okay, we got a couple. Has anybody talked to you about this yet? Okay, so there's not going to be a box on the 2025 return that tells us how much your overtime pay was. And so it's going to be a guess. We're going to have pay stubs, and then a third of the overtime pay we're going to just have to tell them what it is. And it's going to be pretty much an honor system because they're not going to get any information for it. The problem is they changed the rules midway through the year, and so the systems aren't designed to be able to track it. Another thing is you only get the half. It's not all of the overtime pay. It's kind of presented as a whole lot more than it was, but it is the half. So if you make $10 an hour, you get paid $15 on overtime, you've got $5 an hour that is not taxable. So what our firm is doing is anybody thinks they have overtime, they have to bring a pay stub, and then we'll take a third of the overtime pay portion. Does that make sense? But it is not going to be on the W-2s for 2025. It is supposed to be for 2026. It is only for married filing joint less than 300,000, single 150, and it's limited to 12,500 and 25,000, I think. Tax-free tips. Any hairdressers? Okay. Most of our hairdressers are self-employed. They get a 1099, they do a Schedule C. Owners are not eligible for tax-free tips. It is also only for certain industries. I mean, nobody's ever tipped me, I don't think, but it is for restaurants. It is, so the restaurant people are gonna be able to get it. But your hairdressers, I really don't think are going to, because most of them are self-employed. The ones at Great Clips may be able to, but most of your self-employed ones are not. Personal exemption, so we used to get a personal exemption. In addition to like a child tax credit on kids, there are no more personal exemptions. Gambling losses, NBA gamblers, come on. I mean, you're all gamblers to some respect, but, sorry, I guess I shouldn't have said that. So gambling losses have always been limited to gambling winnings. Now you can only claim 90% of your winnings against your losses, and you have to itemize to be able to claim the 90%. Any energy credits are wilting away. I don't know why I said wilting, but we'll go with it. It's an interesting use of that word. But it is kind of what's happening. So typically when you have Democratic presidents, your energy credits are better. If you have Republicans, they're not as good. So clearly that's what's happening. So anything energy efficient you want to do, 2025 may be your year to do it. Windows, doors are still, heat pumps more than 14.2 SEER are still energy efficient if you could get it installed this year. Casualty losses are no longer going to be deductible unless it is in a federally declared disaster area. The deduction has always been better in a federally declared disaster area, but now they're not going to be allowed at all unless they're in a federally declared disaster area. Yes, ma'am.
Speaking of that,
Yes.
a lot of people from our region helped with Helene and whatnot, donated time, resources and things, because we shut down for like 2 weeks, but people were still out there doing a lot of stuff. How can those people and investors that did things out of the goodness of their heart to help people, how can they utilize that in their taxes as well?
They can't. Because they haven't ever paid tax on that labor they provided, they don't have any basis to deduct anything against it.
So wouldn't that be a loss though, if they're not doing their regular job or they're not getting income, couldn't that be classified as a loss?
No. Because you haven't paid tax on the income, you can't deduct the loss. It's a great question. I get asked a lot.
What about classifying as a charity donation? And
Say that one more time.
Like a charity donation.
Because you don't have any basis in your time, if you haven't paid tax on it, you can't deduct the time lost.
No, but if you're donating a refrigerator or whatnot and
Sure.
clothes from the closet and once it's over $600 you have to itemize, could you in some way itemize some of that as
Yes,
well?
yes. So stuff you can take, time you can't unless you pick it up as income. But stuff you can. Anything over $5,000, you have to have an appraisal. You have to be able to itemize. So under $5,000 is pretty easy to take if you itemize.
So if anyone does anything charitable or anything like that, it's $5,000 or less and they're good.
Correct.
Okay.
You have to do an 8283 and you have to have a receipt saying that no goods or services were provided in exchange. But typically there's plenty of charitable that will provide that. So stuff is fine, time is not. Yep. So if somebody itemizes, I tell them that every other year, take a bunch of stuff to Goodwill, get a receipt.
What about working with a nonprofit? Like if, like in selling real estate, like if we're selling a real estate below market value because it's going to someone who's gonna be housing people with a
Ooh, I
nonprofit,
like that one.
and they're selling it at a reduced rate. How can they not capitalize, but how can they be, what can they do with that equitable loss that they're taking because they're trying to be.
Great
this
question.
narrative?
Great question. So if you get an appraisal, you have to have an appraisal, and you give to a charity and no goods or services are given back, then you can take that difference as a charitable contribution. The biggest thing is if they sell the property in less than 3 years for anything less than what you claimed for it, then you have to pick that back up as income. I like land donations a lot. We've done it twice or more than that? Twice that I can think of. Twice we've done land donations. I had a client one time, he had a property, he had $100,000 in basis, property's worth $800,000. If he sells it, he's gonna pay long-term capital gains on $700,000. So he's gonna pay $140,000. Instead, he donated it, got an appraisal, well, he got an appraisal, then he donated. There's some specific time frames. I think it's 60 days, isn't it? 60 days your appraisal has to be before. Then donate it. Then you get the charitable contribution for the full 800 without paying tax on the 700. It's a really nice option. But you can do bargain sales like that too, as long as you have an appraisal.
Okay, let's go back to the bargain sale, because I have one, and the language kind of got misconstrued a little bit with the lender.
Okay?
So I don't think the seller is gonna get anything back. But say a property is valued at 300,000, and they're selling it at 260, and there's a gap of 40,000. If the appraisal comes in at 300, so as long as they don't sell it in 3 years, they can still write off that.
As long as it is to a 501c3, they have the appraisal, and they get a letter saying no goods or services are given in return.
The no goods and services letter, got it.
Have to have that letter. Yep. The other thing is with 40,000, can that taxpayer itemize? Maybe, maybe not. We're right at that threshold. We would be able to itemize, but how much of a benefit are we gonna get from it?
I guess every investor is gonna be different on how
Correct.
that's gonna, because sometimes it may not be of a benefit to them.
Correct.
So you just don't know, and I don't know how that's gonna work in your arsenal. I'm just curious because I've been in that situation where
Sure.
I put in special stipulations that the seller is selling at a below market rate, so they could try to recoup that down the road for what they're doing.
Yep.
So what is the benefit of that? It's just the spread between your effective tax rate and the 20% on your long-term capital gains. Is that your real savings by doing that?
So your savings, in which scenario? Hers,
In your
in mine,
yeah.
it is, so it is the ordinary income on 800
Right.
versus the,
Which is the 20% you're saying.
so
Long-term capital gain.
long-term capital gain would have been 700.
Okay. Yep.
So that's your 140.
Right.
Then you get a charitable contribution at ordinary income for the full 800.
Okay.
And you don't have to pick up the gain.
You don't have to pick up the gain,
Correct.
but you're also
It's actually a double benefit because you're not picking up the gain and you get the full benefit of the 800,000 charitable.
so you did get 800,000 for the land.
No, it was a donation of all of it. So
you
you're
got
out
lost,
that.
But you didn't get the 800,000, right? So
You
it's-
don't get the 800,000. No. So you would have ended up with 800 minus 140.
But in that guy's situation, shouldn't he have just paid the tax and like kept his money?
So he had other motives with it, which is normally the case. And it's not a good or a service. It was right, he owned a pharmacy and it was right next door to the pharmacy and he wanted a community center next to the pharmacy.
Okay. All right.
So, yeah, one of the ones that we did, so the other thing is, I don't know that I want this recorded.
Give me
We'll go
five
ahead.
after.
Do you
No,
want to pause it?
no, we'll go ahead. What you can get an appraisal to say may not be exactly the same as what you can sell it for.
Right.
Especially in some of our rural friend counties. Does that make sense?
Yes.
So, yeah, there's other reasons that you may want to do that. If you
Yeah.
could have sold it at 800, maybe it would have been better.
I see what you're saying.
But it may be that we want to control the neighborhood.
I'm following you.
Okay. Any other questions? He still wants to know what I'm doing. Trump accounts. How many have heard of Trump accounts? All right, good. So there's a lot of unknowns still with these Trump accounts. Any baby born December 31st, 2024 through January 1st, 2029 will receive a $1,000 deposit. There are no income limitations. There are no phase outs. The money can't be withdrawn until the child turns 18. Employers can deposit $2,500 per child and receive a deduction for the contribution. So they're gonna treat these similar to traditional IRAs. We're gonna have basis dollars and we're gonna have non-basis dollars. And it's gonna be a challenge to keep up with how much basis we have versus how much non-basis. When I say basis, does everybody know what I mean? Some of you don't. Okay. So I look at money as red money and green money. Red money means the government has its hold on it. That means there's no basis. Green money means it's free and clear. The government doesn't have a hold on it. That's basis. So if your traditional IRA, 401k, that type of thing, your basis is zero typically. There are some exceptions. A Roth IRA, your basis is the value in the account. All of it is green money. Does that make sense? Your checking account is green money. When you buy a property for $100,000, that $100,000 is your basis. If you sell it for $200,000, until it's sold, you only have $100,000 in basis, even if it's worth $200,000. So it's the amount of dollars that you have paid tax on, which is why if we're trying to count labor, we can't count the labor as a deduction because we have no basis in it because we haven't paid tax on it. Red money can become green, green money can become red. It just has to cross a tax return. Does that make sense? Okay. Everybody follow me? Okay. So we're gonna end up with these accounts with basis and without basis. So if I put $1,000 into an account for my child, I'm not gonna get a tax deduction for it. It's going to create basis. But if Stephen's business puts $1,000 into an account for my child, he's gonna take a tax deduction for it. So now that's red money. That doesn't create basis. I don't know how they're gonna track the basis on these. We're kind of making the bicycle as it's going down the street.
Have they started depositing money for kids
No.
born? They haven't.
July 2026
Okay.
is when they will start that.
Do you have to apply for that for your child?
We think that it will be on the 2025 return, but they don't have that draft part of it done yet that I've seen. If they have, I haven't seen
So
it.
you need to take the child tax credit for them to see that you have the kid for them to make the deposit?
I think there's gonna be another step for it on the 2025 return, but I'm not positive about that. Parents can't start contributing until July 2026 either. Withdrawals can be used for first-time house, education, start a business, and it will be capital gain rates at the child, which will be their now adult tax brackets. We don't know where the investments will be held initially. They do have the website up. I think it's trumpaccounts.org or something like that. Initially, it will be through that site. We're hoping that investment companies will be able to roll those accounts over so that we will have a little bit more control. They are saying that we're gonna be able to invest in ETFs, which I was a little surprised by that, but he's wanting the kids to have the growth on this money. How the basis will be tracked in the accounts, we don't know. We just talked about that with the $1,000 versus the $2,500. The $1,000 that the government gives the kid, there's not gonna be any basis in that either. That's gonna all be red money too. We think that there will be non-discrimination rules. So like I can't give my child the $2,500 but not give my employees' kids the $2,500, but we don't really know what that's gonna look like yet. I think in concept, this is a good concept. In practice, I think there's a whole lot of questions that we still have with it. And I think they need to really move it to private investment companies as opposed to the government holding it. I mean, Social Security has gone so well for them. So, yes, ma'am.
I don't know if this is something we know yet, but
We'll
like,
try.
I have a kid, she didn't go to college, her 529 is hanging out there, we were gonna roll it to her kids for, like, with the Roth IRA. Do you think
So those
it's
are two
possible-
different things. Rolling it to her kids is one thing. Rolling it to a Roth IRA is something different.
Two separate steps, or is that possible or no?
Keep going,
Okay,
but
I'm just wondering if we could maybe go from 529 to, you don't think so?
so it's in your daughter's name? Okay. How old is she now?
25?
How long has the account been established? More than 15 years?
Yeah.
Okay. Is she working now?
No. Stay-at-home mom,
Is her husband working?
yes.
Okay. Does he make more than $14,000 in a year?
Yeah.
Roll it into a Roth IRA in her name. Don't do 529 for her kids. For a couple of reasons. One is the growth on the Roth is tax-free and she can use it at retirement. The other is the 529 rules are not as advantageous as a Roth rule. So you got a lot more flexibility in what you can take it out. So she doesn't have earned income, but as long as her spouse has earned income enough, she qualifies to do a Roth. How much is in the 529?
It's like 15,000.
So you're gonna have to do it over 2 years. So do, she's young, okay, so do 7,000 in 2025, do 7,000 in 2026. It might be 7,500 in 2026, I don't remember what that limit is. But I would go Roth instead of 529. See, I'm still not a fan, but the Roth is just a better option. You've got a lot more flexibility with a Roth. Yeah, that's what I would do. Any other questions?
So,
Yeah,
your 1099 rule going to $2,000.
yep.
What is the recipient's obligation for filing?
They have always had the obligation to file, regardless of if they get a 1099 or not.
So what I'm thinking is the IRA in lieu of the 529, but you have to have reported income to,
You can report the income whether or not you have the 1099.
right, but I didn't know if that changed anything on the reporting side.
No.
Just on the payer.
It's on the payor, yes, yes. Are you paying your son? You said free labor and you made me cringe. Good.
Oh, no.
Okay, good,
Paying him.
good.
'Cause
He doesn't need to know
He
that.
will report it this year.
I understand. Yep. Yep. I did have an issue this year, and it was a new one for me. So Schedule C, if you pay your child, they're exempt from Social Security and Medicare. This year, they have pushed back on that and said it has to be a W-2. Will not allow a 1099. Do a W-2, do 944 to report all of it. Nothing's owed with it. And then it's not subject to Social Security Medicare. Yeah, that one was a new one. I've done it for years and not had a problem. And this year I started having problems with it. But yeah, pay your kids. Anybody have kids and they don't pay them? Okay. He doesn't need to know it. We won't tell him. Lost deductibility. So these are the slides that I felt like needed to be added again, especially with the number of new people. So those of you who were here last year, I apologize. I'm going to repeat myself. Being a real estate professional makes a huge difference for you all. We've got 3 tiers of real estate participation. We have active participation, we have material participation, and we have real estate professional. I get asked the question a lot, do I have to be a licensed realtor to be considered a real estate professional? No. Our criteria is, I ask 3 questions. Number 1, do you have another full-time job? If yes, you probably cannot be a real estate professional. You might be able to be, but it is very, very difficult to prove. I've got a teacher. I've got a little girl this year. She's 21 years old, and man, she's a hustler. She's a full-time realtor. She is a full-time teacher, and she does flips and has rental property. And she came to me and she said, I think I qualify. I said, but you're a full-time teacher. She said, I had to work during the summer and I'm off at 3 o'clock. From 3 o'clock on, I do real estate. All summer, I do real estate. I said, document it, document it, document it, and we'll take it. You have to spend more time doing real estate than you do anything else, which is why if you have a full-time job, it's very difficult to prove that. In her circumstance, she's a teacher. We know they don't, well, you already said there weren't any teachers in here. Okay. So more than 750 hours, more than you do anything else. You cannot aggregate with your spouse, but only one spouse has to qualify for the whole property to qualify. And the reason it is huge is because then you can deduct your loss against other income. Any questions on that?
The more than half of all service activities can include things like searching for new property
Yes.
and stuff, right? It doesn't
Yes.
have to be like of all maintenance or something
No,
like that.
no.
But
Well,
you have to collect all of the service hours that other people perform for you, and then you have to be more than half the
correct,
total.
correct. So if you have a management company, it's not an automatic no, but it makes it a little harder. Yeah,
It also means that the larger you get, the harder it is to qualify as a real estate professional, because you've got a lot of service activities being performed on your behalf for your property, right?
if you are full-time, Yeah, that's a good question.
right? Cause if I've got a full-time handyman, I've gotta work full-time to match his handyman service just to
Sure.
be half.
Sure,
And if I get 2 handymen, now I literally can't do it.
sure, sure.
You don't have another job.
But you still have to be
Still
more than
have-
half of all service activities.
For your real estate business, or is that for half or relative to other income?
That is, you're exactly right. That is half of your service activities.
Okay,
So
half
that
of
is,
my service
so that is your full-time
Okay,
job.
alright.
Yeah, I was like, I've never been
Okay,
asked that.
alright.
That was a good
So you
question.
gotta do real estate stuff more than you do other things you make
That's
income.
what it is.
Correct.
Okay.
So just like with the teacher, if she tracks her hours and she works 1,500 hours in the classroom or doing school, she has to
I'm
be
with
at
you.
least 1,501
Okay.
in real estate.
Yeah,
Yes.
I read it
Thank you,
differently.
Mark. Yeah, no. You cannot aggregate with your spouse, but only one of you has to qualify. I had a gentleman this year, and he was going to do a Roth conversion on all of his retirement money. And he said, "How can I avoid paying tax on it?" And I said, "Well, you're going to have to." He's a real estate investor. I said, "You're going to have a loss on your rental to offset your Roth conversion." And his wife worked. And I looked at her, I was like, "Are you willing to quit?" Sure enough, she quit so that she can perform enough of the activities. We're tracking the hours, and we're going to offset at least a portion of the Roth conversion with a real estate loss. They couldn't have done it if wife still worked. You can aggregate all properties for the election, and then you can deduct the losses. This is another area where real estate investing is a huge benefit because it's no longer passive, but you don't have Social Security and Medicare on it. So it's a very, very nice option for that. Does that make sense? Material participation, more than 500 hours in a year. If your total income is under 150, then you can deduct 25. And we don't want to be in the active participation because you can't deduct any loss. Any questions on that? All right, Section 179 versus bonus. I touched on this a minute ago. Section 179, I've got 2024 numbers, but it's like 1.4 or something like that. You don't want that anyway. So Section 179 was like the good thing for bonus depreciation for a long time. Section 179 has been limited to new equipment. It's been limited to that you could do for new or used. And you can deduct up to 100% of the purchase, but you cannot deduct to create a loss. So let's say you did a cost segregation study and then you wanted to take Section 179. You're not going to benefit from it because you're not going to be able to get in the hole. Bonus depreciation is when you want to do it, when bonus depreciation is 100%. You can create a loss. You can elect out of taking it to take Section 179, new or used property. Most states have not approved bonus depreciation. So Virginia, you're going to end up owing Virginia when you don't owe federal, and then at some point it swaps. You end up having more in depreciation for Virginia than federal at some point in the future, and you're going to get more of a refund there. So it's a scale.
I've got a question, Melanie.
Yeah.
So, with like a commercial roof, it's a 39-year depreciation, so it's not eligible really for bonus when you do the cost seg, right?
On commercial, no. Residential, yes.
On residential, it is. Okay. So my situation's commercial though. So I've got a large loss from depreciation that totally offsets my income, but I also just put a commercial roof on. Can I take the Section 179 first and then bonus depreciate everything after that? You see what I'm saying?
So you are so because you replaced your roof,
Yeah.
you do want to segregate it.
I
Because
can do Section
that,
179.
so that is scrap. You're still probably going to want to do bonus.
Well, I am doing bonus. I'm just saying the bonus already offsets my income. But I can't go negative with the Section 179. So if I want the credit, I need to do that before and then bonus everything that's left after the Section 179.
Why would you not just do bonus? So because of the commercial. Yeah.
The commercial
Yes.
doesn't give
yes.
me anything on the bonus,
Yes.
right? I can't do both
Yes.
of them, right? I
Yeah.
don't have to choose between them.
It depends. So Section 1, no, you can't.
I've gotta
Because,
choose.
yep, because you have to elect out of bonus completely to do, so Section 179 is asset by asset. But bonus is entity by entity. Do you have it in a separate entity or with other properties?
this situation, both of them are in the same entity.
You're
I
gonna
have to choose between them.
Yep,
So then if I just do the bonus, then I have to depreciate the new roof over the 39 years.
correct.
What if both entities are single owner tenures, it's passed through
So-
for, all both are on as personal tax returns, and would that change?
Then you can elect out. But that has to be two separate entities. Even if they're both on that. Now, section 179 combines all entities. So your limits are across all, even if you had an S corporation that flowed to your personal. So the section 179 total limits are across all entities, but you could elect out of bonus by entity.
I got a question. Right now, I'm having a cost segregation done, for two properties. One that I purchased on January 2nd of this year, doesn't qualify for the 100% bonus. I'm having another one I purchased in March, so it would. My theory was I'm gonna do, more than likely gonna be able to get it 100% section 179 on the first one, because I did last year doing that. And then do bonus on the other one. They are in separate entities. Can I do that?
Yes, you should be able to if they're in separate entities.
But that's the key factor
Yes.
there. I didn't even know that was at play. I'm just lucky.
Yeah.
But that's interesting to know.
Yep. Man, I haven't had anybody before that, just January 20th.
That's, I mean, just.
That sucks.
Yeah, oh well.
Sounds like it doesn't matter.
I wanted it last year.
Unless
God,
you
it
had
was
enough
gonna be just as fun.
Income. So do you have enough income to offset the section 179?
I don't know what are the thresholds on
You
that.
can't go below zero.
Oh, I see what you're saying. Yeah, it should work out.
Okay.
It's beneficial.
So you'll have 40% bonus on that one.
I've never been lucky to go below zero, but maybe I'll get there.
I don't know if it's lucky or. Okay. Any other questions on that? Okay. That's all I have. What questions do y'all have? Yes, ma'am.
So if we have complicated taxes, which I'm pretty sure all of us do, do you recommend, because I would very much like to meet with you, but do you recommend trying to do that prior to the end of 2025 in case there's any moves we need to make? Or do you feel like, I'm sure you're voting, I'm sure you're voting.
She's on vacation, so
Do you, what do you recommend for that?
So, prior planning prevents poor performance.
Yes.
However, let's talk and see if there's anything that we can do quickly. I had a gentleman that came in, he had a $60,000 loss on rental property and $50,000 out of retirement. And he said, "Am I good?" And I looked at him and I said, "What does good mean to you?" He said, "Am I gonna owe?" And I said, "No, but you're not good." And so I told him to do a Roth conversion to offset at least his standard deduction so he wouldn't have an NOL going forward. So there are things like that that we can't do before. Now, I did tell him, I said, if you came in on January 2nd, I couldn't tell you to do a Roth conversion anymore. So I would be picking through your $60,000 loss of expenses and figuring out what we can capitalize, because I don't want to lose the standard deduction that you can never get back. It's like a child tax credit. You can't ever get it back. So we want to make sure to capture it, even if we have to create income to do that. Does that make sense?
What
Yes,
about
ma'am.
If people wait and they file taxes before and then they sit with you and they're like, well, my accountant made a mistake, can you go back and amend their previous taxes?
You've got 3 years that we can amend. Yeah.
does that flag anything you think?
So a lot of people ask that question. Do I think it really flags? I mean, the IRS would have to be able to pick up the phone to be able to flag much. They are so backlogged. It is a nightmare. If I'm not comfortable with putting it on a return, I'm going to tell you can't amend. If I put it on a return, I'm ready to go through an audit with it. So I mean, that's kind of where I am with it. Does it flag something? I've never had one that was amended be audited. Yeah, never. There's other people who think wait until the last day triggers an audit. There are people that think that doesn't trigger an audit. I went through, so I was licensed in 07. I probably went through 10 audits prior to 2020 and have had none since then.
Are you serious?
Yes,
Wow.
yeah. And none of, knock
Yeah.
on wood, none of the ones that I went through, did they change a dollar. One of the questions they will ask if you go through an audit is there anything questionable on the return? If you say no, that is the wrong answer.
Really?
You always have something that you have your documentation for, and then you narrow their scope. It's worked for me up to this point anyway. So, do you all, how many of you all have been investors since early 2000s? Anybody? Okay. So in early 2000s, 2005 to 10 probably, there was a huge push that everything has to be capitalized. The heat pump needed to be a 39-year asset. Do you remember this? And they gave an example, and I can't find it now, but they gave an example at that point that if you had 3 windows on the building and 1 is replaced, then it's a repair. But if 2 are replaced, then it needs to be capitalized, which was a ludicrous example. But I have relied on that a lot. And I had a gentleman who went through an audit in that year. So swings, spikes up and spikes down, I do believe that was what triggered the audit on that one.
Swings.
He had really high income one year and a big loss the next year. And so they asked if there was anything questionable on the return. I said, I took a heat pump and I took it as a repair. And she gasped and was very dramatic about it. And I said, here's my documentation. Here's why I did it. And she was gone in half a day, and it was a no change audit. Because we had 3 heat pumps. So we had 3 heat pumps, so I took 1 as a repair, and it was a no change audit. I offered even to take her to his shop. I really hoped that she wouldn't take me up on it. She didn't, thankfully, but just to justify it was 1/3. So that's kind of become the rule of thumb, is if it's a third or less, you can take it as a repair. If it's more than a third, then you need to capitalize it. Yes, ma'am.
Okay, I had a roof repaired a year and a half ago, and it leaked really bad. It was a bad job. The guy wouldn't warranty the work. Well, the warranty he only put on it was 1-year warranty. So at the end of the year, I hired another company, and they went in and totally redone that roof. So now I'm gonna have 2 roofs.
Dispose of the first one. It wasn't worth anything.
Okay. Okay.
Yeah.
She takes it all as basically the first year as an expense, not a.
You write it off completely and then take the depreciation. Yeah. Any other questions? They're a lot quieter than last year.
Awesome.
Your
All right.
confidence is impressive.
My what?
Your confidence.
I actually was really nervous this time. I've never been nervous.
But now, like, you're answering things, you're like, do this, I'll do that.
Okay.
There are new people with taxes, they're like, well, sometimes we put it here, this could trigger this, we structure that over this way, and the way that you're answering questions and just, it's, the poise and the confidence is very reassuring.
Well, thank you. I
Taxes
appreciate
make
it.
everybody nervous.
I love them. I think they're a lot of fun. You
All right,
can.
let's give Melanie a round of applause.